Hey, this is Kyle Seagraves, and today we're going to talk about mortgage interest rates and what determines the interest rate that you'll end up getting. So I get calls from clients all the time who are asking, hey, what's your rate? It's kind of a loaded question, really, because there isn't one set rate that you'll get or that a lender has to offer. Your rate is based off of two main things. Number one is the financial market. It's based off of how the market is performing. So how are mortgage-backed securities performing, how are treasury bonds performing, and the overall prospect of the economy. So when you're shopping lenders, keep that in mind that you're going to want to look at rates on the same day, because day to day, different things can change in the market that will change the overall rates that lenders have access to. So number one is the financial market. Number two is the risk profile that you have as a borrower. So there are over 30 different ways that a mortgage rate can be impacted. But the main way are through things. One is the loan to value ratio. So how much money are you putting down? The second one is your credit score. So if you have a lower credit score, you have a higher risk of defaulting or missing a payment on that mortgage. So your rate is going to be higher to compensate for that risk. Whereas if you have a high credit score, your rate's going to be lower because you have lower risk of defaulting or missing a payment on that mortgage. And then the third thing that will affect your rate greatly is what type of loan product are we using? Are we using a conventional loan, an FHA, a VA, USDA, a jumbo loan? Is it a portfolio loan? All of these things come into end up shifting the way our rate looks. So the way this happens on the back end is that all programs will have kind of what's called a par rate. So it's, if you're, imagine like it's a game of golf. So there's a par for what you expect, how many strokes it's going to take to meet the par for that course. It's the same thing with mortgage rates, is there's a par, and it's the baseline of what the rate is going to be for a program. Now on top of that is when we add in adjustments for different risk profiles of you as a borrower. So we might have the base rate, and then let's say you have a credit score that's above 700. Well, you're going to get the benefit of being able to have a higher credit score. Or on the opposite end, let's say you have a lower credit score. Well, you're going to get hit with a higher rate or a higher rate adjustment because you have a lower credit score. So those are the two big things. We have the market and then your risk profile that will determine the rate. So now that you know that, when you see things on Zillow that are advertising rates, or you see this on other websites advertising, here is our 4.375% rate. Well, if you look at the little disclaimer at the bottom, it's going to show you all of the factors that are coming into that. Most of the time, it's a really big mortgage with a lot of money down, with a really high credit score. Everything is really clean and easy. So this is something to keep in mind as you're looking at rates. There isn't one rate. So what you want to do is make sure that you talk with a lender and understand everything that's going into how the rate is being created for you, and all of the risk factors that are being taken into consideration. That way, you know exactly what that rate's looking like, and you have the opportunity to say, hey, if we change this one thing about our loan, or if we spent a couple months working on our credit score, our rate could effectively change for the better. So hopefully this helps out a little bit, clears up some mystery behind where these rates are coming from. They're based on the market and they're based on your risk profile. But if you have any questions about rates and everything that goes into them, feel free to let me know. On the screen right now, I went ahead and put on 30 different factors that will affect rate. Some of these are going to affect more than others. Again, the three big ones that are going to affect rate are the loan to value, your credit score, and the loan program. So take a look at that. Hope this helps. Feel free to share this if this was helpful to you and you think could be helpful to someone else. And I will talk with you soon.